2 of our Chapter 3 video lecture. And what you're looking at is where we had left off in the Part 1 video. That's the consolidated worksheet at the end of the first year. Remember, at this January 1st, our parent company had acquired the stock, all of the stock of its Sun company. And we got our consolidated totals over here. Okay, so let's stick with this equity method, but now jump from year to year to year, 24, 25, and we're going to be doing the same consolidated worksheet for the year ending 2026. But we should always have some type of subsidiary record keeping track, in this case, of the income that the parent is accruing each year from the sub, the dividends being received by the parent from the subs. You can see the change in book value. This book value is not the parent, but it's the subs here, in this case, increasing the balance each year. And we're going to see, because it's being accrued on the parent's books, we have to reverse it out because that would be duplicating the revenue and expenses on the consolidation. Likewise, the dividends have to be reversed out. Additional information we're given for the year 2026. We're told that our parent company still owns all of the stock of the sub, no change there. Something new, though, for 2026 is that our subsidiary has borrowed money from the parent in the amount of $40,000. So on the records of the subsidiary, it will show a liability, or here, P for payable. P is the letter of the consolidated entry we're going to have to use to get rid of this liability. Likewise, on the books of the parent company, it should show a receivable asset of $40,000. And this has to be eliminated because you cannot owe money to yourself in that consolidated group. Okay, so this is going to be a new entry we're learning here compared to the SAIDE. Yeah? Now, P for payable. Also, we're told, like we saw on the previous screen, this retained earnings of the sub is going to be eliminated. That's one of the first entries we do. Remember, it's the beginning of the year retained earnings amount. Yeah, not the ending that has to be eliminated. And then book value. Yeah, guys, we saw that in the previous screen. More information, again, for the year 2026. So the subsidiary had a net income of 160 that was accrued as investment income on the books of the parent company. Also, it was reduced by, remember, the amortization, the net coming out to 7,000. Well, all of this has to be reversed out because we don't want to duplicate it on the consolidated worksheet. Like here we're told the 160 is here, and then the 7,000 is really this amount here. But because we're reversing it out here, 153, we got to put this back in. Yeah, this is, if you take it out, it's not being reported anywhere. So now we got to put it back in as adjusting entry letter E. This one here, 153, we eliminate this. That's adjusting entry I for income. And then this 70,000 dividend, that has to be reversed out. That's adjusting entry letter D. So let's take a look at well, here's more information. This whole slide is just about the new receivable payable that has to be eliminated. That's the 40,000, yeah? Because this is a liability that we get rid of. It's going to be a debit, yeah, offsetting the liability on the books of the sub. And the same amount, they call it reciprocal, 40,000 asset receivable, eliminated with a credit. So again, not uh, 2023, but 2026. So the parent and sub has closed out their records, and now we're consolidating everything into this totals here. So the first one was S. We get rid of the common stock of the sub. We get rid of the paid in capital of the sub. We get rid of the beginning retained earnings of the sub. All debit, debit, debit. And of course, the offsetting credit is to reduce the investment in the sub on the books of the parent, ultimately zeroing it out here. So we got the bulk of the amount being zeroed out with this 820. So that's S. And then the second entry is A, to update the excess costs of these assets here at the time we bought the subsidiary. And the trademark and goodwill, A here 20 and A here 80, is still the same as we had seen back in 2023. It hasn't changed ultimately in the totals down here because we don't amortize the trademark. Yeah, we don't amortize the goodwill. Of course, they're subject to impairment, and we'll cover that at the end of this chapter. Now, this A for patent and this A for equipment has changed compared to 2023. And the reason why is because it's been amortized over the past 3 or 4 years. So the amount of carrying value in the consolidated group should be decreased. So if you compare this 91 to patents and this 12 for equipment, compare it to the 2023, they're smaller because the amortization, yeah, the accumulated amortization is reducing the balance here. And likewise, if you do next year, 2027, the A debit here and the A credit is going to be even smaller. Okay, so this is a little bit different compared to um, the calculation for previous year's consolidated entries. So that's A. And then I, of course, is to get rid of the um, income from the income. Where's my income? Income from the sub. This 153 here, yeah? Again, we get rid of this because we don't want to duplicate it. You can see it's zeroed out here. We don't want to duplicate any of the sub's income when we combine the revenue expenses all together over here. So we get rid of this with a debit. And of course, the offsetting credit is to reduce the investment account. Okay, that's I. And then D is to get rid of the dividend paid by or declared by the sub. That's this 70,000 here. Really, we're putting it back, yeah, with a credit and putting back the costs in the asset account. Okay, that was D. And then E is to record the amortization. In this case, to increase the amortization of the patent, decrease the depreciation expense. And here's the offset here, yeah, to the net book value of the asset. And of course, the new one, that's P. So sitting inside this liability here on the records of the sub is 40,000 owed to the parent. So we get rid of that, yeah, debiting the liability. Likewise, sitting in this current asset is receivable here, receivable from the sub, getting rid of that asset with a um, credit. And the ultimate result, again, is our consolidated totals, eliminating the investment account, this $1 million amount, yeah, down to zero, and duplicating the equity accounts of the parent here in the consolidated group. Okay, so we kind of know that's a check to determine whether we're on the right track or not. So again, this is the equity method, just like we saw in the first video, but now in a subsequent year, subsequent to the year of acquisition. So let's move on to another method that the parent can use to track its investment in the sub, and that's this initial value method. There's really two methods here we need to still look at, that initial value method and partial equity method. Not equity, yeah, but partial equity method. And because this is being done on the books of the parent, the adjusting entries or the consolidated entries we use on that worksheet are going to be different to get the same consolidated totals we see on the worksheet. Okay? Again, this is the first column, yeah, being different. So then the um, adjustment columns, the consolidated entry columns are going to be different to come out to the same consolidated totals, as mentioned in here in this last sentence. With the three different methods, what's going to be different now on the books of the parent is how you account for the investment asset account. Also, the amount of income that the parent is going to accrue coming from the subsidiary. And really, this income here is then going to make a difference in the retained earnings of the parent. So the same journal entries or the same adjusting entries or consolidated entries. The S entry to get rid of the stockholders' equity of the sub is still the same as before. Again, we're looking at now at the initial value method. Even the partial equity method, same thing as the equity method. We get rid of the beginning, well, we get rid of the stock, capital stock, additional paid in capital of the sub, and the beginning retained earnings of the sub, which could be different under the three different methods, but you still zero out that beginning retained earnings. Then the second entry, again here still the same as before under the equity method, you're updating the carrying value of the assets to that excess amount we had paid on acquisition. Really, I shouldn't say acquisition. Really, the carrying value that should be at the beginning of the year. Remember, it's being amortized, right? Reducing it. And then I is to get rid of the income that was accrued by the parent on the books of uh, getting rid of the income accrued on the books of the parent. Now, under this initial value method, the income being reported by the parent is not the profit of the sub, but the dividend declared by the sub. So that's going to be reversed out here under the I adjustment. Yeah, different than the I adjustment under the equity method. And because we're taking care of zeroing out the dividend here under the I, under the initial value method, we don't need to eliminate the dividend like under the equity method because it's already being done here under I for the initial value method. And if you remember that $7,000 adjustment, yeah, for the amortization, that's the same as before. Nothing different there. So again, at the end of not 2026, but 2023, the first year, using the initial value method, we still get rid of the beginning retained earnings of the sub. You can see right here, get rid of the capital accounts of the sub, and the offsetting credit is to reduce the investment account on the books of the parent. Letter A is again to update the carrying value of the assets, including the reduction of the equipment, and netting out again, reducing the asset here. SAI is to reverse out the income. Now, the income reported on the books of the parent is not the profit of the sub, but it's whatever dividend that was declared by the sub. So we get rid of that income with a debit, and the offsetting credit is to put back here the reduction in retained earnings on the books of the sub. Yeah. So that's I. And then notice we don't have a D to reduce any dividend because it's already done over here. And then the E is the same. Yeah. Adjustment to the excess amortization. Okay. So zero out the investment. And if you look at the equity here, common stock of the parent, common stock, additional paid-in capital of the parent, it shows over here. But notice if you take you cross-foot for the retained earnings, it's different, yeah, than the retained earnings of the parent. How come? Because we accounted for the income differently than before. I think this 40 and the net of 7 combined really with this 440. If you plug it here, yeah, those three amounts, really it's retained earnings. Yeah, you're plugging it here. You'll come out to this total here. The same exact totals here under the initial value method as we had seen previously under the equity method. Exactly the same. Yeah. Again, because we had accounted for the investment in the sub differently in the books of the parent, this column here is different under the equity method versus this initial value method. Thus, some of the entries here are different to get the same consolidated totals. This is just a summary why things are different under the initial value method compared to the equity method. Let's move on to the third method, and that's partial equity method. Almost like the equity method. Same S entry to get rid of the beginning stockholders' equity of the sub. Same adjustments to the assets, updating it to the beginning of the year amounts for the excess amount that was paid. And then eliminate the I income. In this case, it's not the dividend income we're eliminating, but the accrual of the sub's net income on the books of the parent. And then just like the equity method, we got to get rid of the dividend. And again, same amortization of the excess costs here under E. Okay. So again, what's different in this parent column compared to the full equity method is that the 7,000 net amortization is not recorded. Okay. So you don't have to reverse it out, but you still put it back in here using this E entry. We still zero out the investment account. We still carry over the capital accounts of the parent. Again, this retained earnings here doesn't match this because, again, it's a combination of this really $7,000 off because that wasn't recorded. And I shouldn't say just 7,000 because it's only 7,000 at the end of the first year. That difference is going to get bigger and bigger because of the accumulated amortization. Yeah, just a summary of the different adjusting entries we need to make based upon which one of the three methods we're using. Here in the next section of our presentation, let's take a look at not the first year after the acquisition, but subsequent years. So in our example here, what we're doing is comparing the effect of the equity method, that's accrue method, and the initial value method and partial equity method. Accrue method, we've accounted for all of the income of the sub. accounted for a reversal of the dividend and all of this amortization of the excess costs. But in the case of the partial equity method, it's pretty much the same as equity, but we didn't do that annual amortization. So if you're going to be doing this partial equity method, let's say at the for the year 2026, what you got to do is now record this 21,000 adjustment to reduce the retained earnings, yeah? Because this wasn't accrued, this expense wasn't accrued under the partial equity method. You got to reduce your beginning retained earnings by 21,000 before you do all the other adjustments. That's 21. Okay, and then the initial value method, you recorded none of the subsidiaries' earnings on the books of the parent. So all of this has to be recorded. And you got to reverse out this dividend income. And you got to record the 21,000 of amortization. So if you're doing this initial value method at for the year 2026, all of this information for these years have to be updated. Or this net here, I think it's 199,000. You got to increase the retained earnings by 199,000. Or if you're doing the partial equity method, the difference here, this 21,000, you got to reduce it down by 21,000 here. So if let's take a look at the worksheets. The worksheets. So this is the initial value method. Remember that 199,000 I mentioned? You gotta increase the retained earnings of the parent to account for all of that unrecorded profit of the sub, and the offset is to reduce the investment. So let's take a look at the worksheet using the partial equity method. The adjustment here is to reduce the retained earnings at the beginning of the year for 3 years worth of amortization that wasn't recorded. Again, under the partial equity method compared to the equity method. Otherwise, all of the other adjustments are pretty much the same. And again, the a little bit tricky one is the A because it's being reduced each year for the net amortization, accumulated amortization here. So here's a summary. I think I showed you this in the beginning of the first in the first video lecture for this chapter. And here is that new entry I just showed you to account for the difference between the equity method compared to these two other methods. Yeah. And so you pretty much do this entry at the beginning of the year. This one was that $21,000 adjustment. This was the $199,000 adjustment. So you probably do this first to update the beginning retained earnings balance. And then you go through these other adjustments we had talked about. And then that's for the first year, yeah? And then subsequent years, almost everything is the same, except again, remember that tricky one for the A, the unamortized amount is going to get smaller and smaller because of amortization each year. Okay, I think that's it for this video. So when we come back to part 3, we'll talk about goodwill and possibly its impairment.